Understanding implied straddles. A simple look. Implied straddles are tools used by options traders. They help us understand possible price moves. This is done without predicting if the stock goes up or down. Think of an option as a contract on future stock prices. A straddle combines a call option, trading on price going up, and a put option, trading on price going down, with the same strike price and expiration date. The implied part is key. It's based on the current price of these options. It tells us what the market expects the stock to do. In simple terms, the implied straddle is the average cost of both the call and put options. It shows us how much the market thinks the stock might move before our options expire. A high implied straddle means big moves are expected. Calculating the implied straddle is pretty straightforward. You add the price of the call option to the price of the put option, then divide by 2. This gives you the average cost of the two options, which represents the market's expectation for the stock's price movement. For example, let's say a stock is trading at $100, the $100 call option costs $5, and the $100 put option costs $4. The implied straddle would be $5 plus $4 divided by 2, which equals $4.50. This means the market expects the stock to move up or down by $4.50 before the option's expiration date. Remember, the implied straddle is just an expectation, not a guarantee. The market can be wrong, but it gives us valuable insight into what other traders are thinking. A high implied straddle might mean traders expect big news or events. A low implied straddle could mean things are expected to be quiet. The implied move is closely related to the implied straddle. It tells us the expected percentage move in a stock's price. It's like the implied straddle, but shown as a percentage instead of a dollar amount. To calculate the implied move, we divide the implied straddle by the current stock price and multiply by 100. This gives us a percentage. Using our previous example, the implied move would be $4.50 divided by $100, then multiplied by 100, which equals 4.5%. This means the market expects the stock to move up or down by roughly 4.5% before the option expires. The implied move helps us understand the potential risk and reward of trading a particular stock. A high implied move suggests bigger potential profits but also greater risk. Traders use implied straddles and implied moves for a variety of reasons. They can help us gauge market sentiment. A high implied straddle suggests traders expect volatility, perhaps due to an upcoming earnings report. They can also help us find trading opportunities. If we think the implied move is too high, we might sell straddles, hoping the stock stays within a certain range, and they help us manage risk. By understanding the potential price swing, we can adjust our position sizes accordingly. Implied straddles and implied moves are powerful tools, but remember, they're just one piece of the puzzle. We always consider other factors like company news, economic data, and technical analysis before making any trading decisions.